So on Wednesday, for the first time in almost 7 years, since the week of March 22nd, 2013, gold prices in US dollars finally touched the $1,600 per ounce mark. Now, obviously, we're not back there yet. We've had a correction again, which is fine with me. It's perfectly normal to have paper price smashes, corrections, people who are taking profits who are more short-term oriented traders. The gold price is still holding fairly strong at $1,562.10, and silver seems to be catching a bid, wanting to stay above $18. But in spite, the point I want to talk about is that smart money is, with price action, whether it's geopolitical risk, central bank risk, is buying the dips. I think there's a lot more evidence that a lot more big money professional investors are buying the dips. Also central banks. There's a central bank article about gold buying I'll talk about in a little bit. But the gold price is, in US dollars, is showing remarkable resiliency lately in spite of a record amount of open interest on paper futures contracts, in spite of the dollar actually rallying a little bit on the dollar index. So I remember talking with dollar bears last week, people who do technical analysis and do a lot of currency trading. They were adamant that the dollar was in a permanent downtrend. The dollar index, DXY, was in a permanent downtrend and it would not go above 97 again. And they said 97.2 was the high and it would not go above that. And here we are. The dollar index is not below 96. It's not even below 97. The dollar index is at 97.36 when we're doing this. Yesterday it was at 97.5, and the gold price in US dollars is showing remarkable resiliency in spite of the record amounts of open interest of paper futures contracts. Now remember, there was a massive amount of paper futures contracts open in 2010 and 2011, and that did not stop the gold price and the silver price from rocketing higher. So at certain points, the bullion banks and the people who are short paper futures contracts can get caught off guard if enough people buy physical metal. Eventually, that can happen. And then you've got people like Jim Bianco. I respect Jim Bianco a lot, but I think this one particular call he talked about in the last day or two is ridiculous. Now, he's been publicly admitting that he's been buying physical gold on dips for a while, and he's not a gold bug. But he said recently that there was a blow-off top in gold when gold touched $1,600 an ounce on Wednesday. And I responded to his tweet about that, which got a lot of retweets. And I was like, how is there a blow-off top in the paper gold price in US dollars when the gold price in US dollars is not anywhere near an all-time high? It's not anywhere near or at an all-time high like the paper gold price is in a lot of other currencies. For the gold price to be in a quote-unquote blow-off top, the gold price would have to be at 19,000, that was a Bill Holter Freudian slip there, at $1,900, within a couple weeks or a couple months, or $2,000 within a couple months or something like that. It would have to stratospherically go a lot higher. So Jim Bianco saying that gold is in a blow-off top because it went up like an extra 50 or 60 bucks in a week or two is not really, it's not a blow-off top. Okay, he's not familiar with the gold market that much, but he knows enough about the global macro problems and the problems with these governments and central banks and the repo market to know that he should be buying gold and accumulating on dips. So just wanted to put that out there, that the gold price is showing remarkable resiliency because the dollar, normally people would need the dollar weaker in the past for gold price to go up in US dollars, and that's not happening. So the gold price is showing quite a bit of strength. Now, obviously, there was geopolitical tension, and that's also why the gold price rose. But it does appear to me with the price action that people are accumulating metal on the dips. Also, you have this article that came out from Shift Gold on Thursday. Central banks continue, quote-unquote, remarkable gold buying spree. Central banks continue their remarkable gold buying spree in November and remain on pace to eclipse 2018's near record purchases. According to the latest numbers from the World Gold Council, central banks added 27.9 tons on a net basis to official gold reserves in November. That brings the yearly total for 2018, with 1 month left, to calculate to 570.2 tons, 11% higher than the same period in the previous year. So in 2018, central banks purchased just over 650 tons. According to the World Gold Council, that was the highest level of annual net central bank gold purchases since the suspension of dollar convertibility into gold in 1971, and the second highest annual total on record. The World Gold Council bases its data on information submitted to the International Monetary Fund. Turkey led the pack for the third straight month, adding another 17 tons of gold to its reserves in November. The Turks have leapfrogged the Russians as the number one gold buyer in 2019, with over 181 tons added to their hoard. Wow, it's a lot. Turkey consumers are also flocking to the yellow metal Turkish consumers, because they have currency problems. So that makes a lot of sense for people in Turkey to be accumulating a lot of physical gold, because there's so much problems with the Turkish lira. According to Bloomberg, gold demand was up, which is rational. If you're having problems with your currency, people should look to either other currencies or gold or Bitcoin, or they should rationally say, I don't trust my currency anymore. According to Bloomberg, gold demand was up 3.7% in the first 9 months of 2019. The country's government, that's in Turkey. They didn't do a good job of that grammar on the Zero Hedge article. The country's government has loosened rules governing gold imports to meet the growing demand. Russia added another 9.7 tons of gold to its reserves in November. That brings its total gold purchases to nearly 149 tons so far in 2019. Russia's quest for gold has paid off in a big way. The Russian central bank's gold reserves topped $100 billion worth of gold. Topped $100 billion in September, thanks to continued buying and surging prices. The Russians have been buying gold for the last several years in an effort to diversify away from the dollar. Russian gold reserves increased 274.3 tons in 2018, marking the fourth consecutive year of plus 200 ton growth. Meanwhile, the Russians sold off nearly all of their U.S. Treasury holdings, but did not collapse the dollar and did not collapse the U.S. Treasury market, at least not yet. According to Bank of America analysts, although January is still, it's 4 more days left for January 14th, guys. 4 more days. If January 14th comes and nothing happens, I may have to do a sarcasm show the next day. It's just getting ridiculous with these dated predictions. According to Bank of America analysts, the amount of US dollars in Russian reserves fell from 46% to 22% in 2018. After pausing for a couple of months, Kazakhstan got back into the gold buying business in November, adding 4.6 tons of gold to its stash. Other gold buying central banks in November were Mongolia, with only 2 tons, and although Mongolia needs to get that Oyo Tolgoi mine fixed, those problems there, that should be their main priority, because that's a lot of cash flow if they can get that mine fixed. It's so massive. And Thailand with 0.1 tons. Colombia was the only big net seller, divesting itself of just over 5 tons of gold in November. For the second month in a row, the People's Bank of China did not report any gold purchases. It's not uncommon for China to go silent and then suddenly announce a large increase in gold reserves. The World Gold Council called the scale of central bank gold purchases in 2019, quote, unquote, remarkable. Following the 50-year high in 2018, few, including us, this is quoting from the World Gold Council report, following the 50-year high in 2018, few, including us, expected the buying strength we have seen. So the World Gold Council clearly is clueless and doesn't understand the global macro situation, because why, if central banks were accumulating gold in 2018, why would they stop buying gold in 2019? Because the global macro problems have only gotten much, much larger and much, much worse. With all the warnings that are coming out lately from the World Bank, the IMF, the Bank of International Settlements, multiple warnings there, and then the instability reports from the central banks with the European Central Bank, the Federal Reserve, the Bank of Japan, all those warnings too. So all the warnings are coming out. The chief financial officers of these large corporations are worried. So it's only a matter of time. I don't know the exact timing, but there's a lot of warning signs out there. Meanwhile, the stock market has hit Dow 29,000 for the first time in history. So that's clearly signs for me as an Austrian school economist, someone who loves the Austrian school of economics, that this is the melt up or crack up boom. The central bank gold buying spree is expected to continue into 2020 as countries continue to create a hedge against geopolitical risk and diversify their reserves away from the dollar. World Gold Council Director of Market Intelligence, Alastair Hewitt, said there are two major factors driving central banks to buy gold: geopolitical instability and extraordinarily loose monetary policy. Central banks are looking toward gold to balance some of that risk. We've also got negative rates and yields for a large number of sovereign bonds. The extraordinarily loose monetary policy shows no signs of reversing. The Federal Reserve appears to have paused rate cuts because they've gotten the yield curve uninverted for now. But Chairman Jerome Powell has made it clear, I added that part with the yield curve, has made it clear that the central bank does not plan on raising rates, even if, I'm getting a lot of text messages here, even if inflation begins to heat up. Peter Schiff has talked about central bank gold buying. He has noted that the U.S. went off the gold standard in 1971, but he thinks the world is going to go back on it. I disagree with Peter Schiff there. That is not why people are accumulating physical gold. They are these central banks and private citizens are accumulating physical gold, not because they're going voluntarily back onto a gold standard, but for insurance and wealth preservation and to hedge against a financial collapse and to hedge uncertainty and political risk, and hedge inflation and problems with their own currencies. I do not think, unless something drastically changes, and I see no evidence of this, no government will voluntarily go back onto a gold standard. It will not happen. It will not be voluntary. It would have to be forced. There would have to be a bunch of market participants that would have to say that we will only accept gold. And, a lot of financial professionals don't see things that way. There are people like me and others who listen, my listeners to this podcast are a very tiny minority who want to go back onto gold or silver or some type of bimetallic standard. We are definitely in the minority camp. Ron Paul made a similar point in an episode of Liberty Report. He said foreign central banks are increasingly gravitating sound money like gold and ripping themselves away from the Fed's dollar. Central banks of the world are looking at gold again. Okay, I'll take a look at listener questions and comments now. So these higher metals prices now, if we stay above 1600 for a while or go higher in US dollars, that might mean some of the mining companies, not only are they making better operating cash flow if their margins are not being squeezed with higher oil prices, so they should have better margins, they should have more free cash flow, more total revenues and better free cash flow. But some of these mining companies that need to raise capital, investor appetites from pension funds and institutional investors, if the gold price goes to 1600, 1700, the sentiment for professional money managers may change about funding some of these junior explorers or also funding some of these producing miners who want to raise capital. Who needs a timeout? I have no idea what happens on the 14th. I think it's a ploy to sell newsletters and to get buzz. Someone was speculating that that's when the initial repos were supposed to expire, but all the Fed has to do is just issue a new press release. Finance Freak says Fed is trapped and will have to keep liquidity flowing to keep the market up. Bet they're pooping their pants every day. I don't know if they're pooping their pants, but they view moving the stock market higher like Dow 29,000 as non-inflationary. In the speeches that the Fed has given, they view that as creating wealth for Americans. And then they claim that there is no inflation. even though they want to increase their inflation target. The Fed's like, there's not enough inflation. There's academic economists coming out with research papers lately saying that there is no inflation, that there's been deflation. Even though the Fed has a 2% annual inflation target, and there's people who work at the Fed now as PhD economists or former Federal Reserve PhD economists who want a 4% annual inflation target, which is just ridiculous. Not that that's how you measure inflation with the CPI, but the Austrian School of Economics definition, which I've talked about this many, many times over the years, is an increase in the money supply and credit, and that's monetary inflation is what the Austrian School definition of inflation is, and then that leads to higher prices. Higher prices are a symptom or an effect, not the cause of inflation. RB says $2,000 an ounce gold this year, no sweat. RB, I do not share your optimism. I think we will eventually get to $2,000 an ounce gold because the Fed is trapped. Who's going to buy all the U.S. Treasuries? Who's going to buy all the U.S. Treasuries? The foreigners are certainly not buying it. The foreigners are not running trade surpluses right now. There's a lot of... Now, foreigners need dollars, but I've talked about this. There's a big distinction now for months that foreign governments who have overborrowed in dollar-denominated debt and dollar bonds, they need dollars. They do not need treasuries. Even if they wanted to buy treasuries, a lot of these countries cannot buy treasuries, U.S. treasuries, because they're not running large trade surpluses. So they have enormous financial problems, and when they don't run trade surpluses, they don't have surpluses to recycle into U.S. treasuries, so they can't buy treasuries even if they wanted. So, someone still has to buy the treasuries. The question is, who's going to buy the treasuries? Easy answer probably is the Fed. At least the Fed will be the majority purchaser of the treasuries. If you believe Victor Sperandio and his thesis, then the large banks will start stuffing even more into hold-to-maturity accounts. 782 asked, did I see the latest Fosterville coming online, 50 grams per ton? Yeah, so that would, in my opinion, that would confirm a lot of what Eric Sprott has said, because Eric Sprott was talking about 60 grams per ton drill hole results, but I think they only had some 40 grams per ton areas that they were mining. So pretty nuts. Yeah, I mean, Fosterville right now is the highest grade, the lowest cost gold mine on the planet. It's not a massive mine, but it's got the best margins and the best free cash flow. But there still is a pretty big disagreement over how many more years of high-grade reserves Fosterville has. They're waiting, a lot of people, including myself, are waiting to see new resource and reserve estimates on the new drill zones in the Swan Zone. Now, Eric Sprott he's made a lot of money on his bet on Kirkland Lake Gold, the company that he merged with Kirkland Lake Gold that was in Australia first. I think it was Newmarket. So he's made, I think, $500 million on that bet in the last 4 years or so. So he's been right for 4 years, making a ton of money on that bet. We'll see if he's right and Fosterville announces an absolutely enormous resource increase or reserve increase on the Swan Zone there with very high-grade gold. So I don't know anything more than what Eric Sprott has said publicly on the Sprott Money podcast about that. So we just have to wait and see. Oh, RB, you were saying $2,000 an ounce silver and it was a joke? Oh, sorry, buddy. Brian, it's more complicated than that because then the government and central banks have no flexibility for bailouts. So if you go on a gold standard, you have zero flexibility because then there's convertibility and redemption on a gold standard, and you have to allow foreigners then to take delivery of said metal, of said gold, and then it leaves the country. I would study the gold standard more and what it actually means, and what central bankers have said and academic economists have said why they will fight tooth and nail to never go back onto a gold standard. And a lot of the times they talk about flexibility and elastic money supply and credit. Prop up Brent crude oil? No. I mean, I like Greg, but a lot of his predictions for a while have been wrong. I'm friends with Greg Manorino, but a lot of his predictions lately have been wrong. No, I don't agree with him. I politely disagree. If you're gonna do a bunch of bailouts like the Chinese government is doing, and the Chinese government's accumulating a massive amount of gold, physical gold, but they don't want the physical gold to benefit the citizens. And the Chinese government's doing an unbelievable amount of different bailouts now. It's the amount of bailout. I have all the slides basically done for a short video on all the different types of bailouts going on in China. There's a lot since May of 2009. There's a lot of different kinds. It's crazy. And there's so many different types of bailouts, and it's so complicated with all the different moving parts and bailouts that the Chinese government and People's Bank of China are doing, that she just hired 12 bailout czars to manage it. That's how complicated it is. So all these people are like, oh, if you have the gold, then you make the rules, and China's going to go to a gold-backed yuan and all this other stuff. And China's behavior lately doesn't indicate any of that. In fact, China's going crypto yuan. It's going more control. They want to unlimited cheat code, unlimited print, unlimited backdoor into the crypto yuan. So they don't even have to print the yuan. And it's easier to just create almost unlimited for the government. There was another story that just came out today that China has the crypto yuan. They just gave an update on the crypto yuan, and they think the testing is going well and it's almost done. Why couldn't you still have a credit card on a gold standard, but based on a real asset instead of fiat? Because there would be no convertibility or redeemability. So if you're doing a fractional gold standard, then people aren't going to trust that you're running a gold standard, and your currency is going to come under attack. Probe, that's why those are questions I answer normally in bonus material to Patreon account contributors. Behind the paywall. Sarah says, and I 100% agree with her, there isn't a government in the world that wants a gold standard. It limits their spending. Exactly. It also prevents them from doing bailouts and prevents them from giving contracts to their crony buddies. So I doubt China would even try a fractional gold standard, because countries that have tried fractional gold standards, their currencies historically have come under attack. But right now, the People's Bank of China on a lot of currency trades, if you tried to short the yuan, your counterparty on the other side of the trade, according to Tavi Costa, who I interviewed, the hedge fund manager, about 4 or 5 months ago, his counterparty, he shorted the Chinese yuan, and his counterparty on the other side of the trade was the People's Bank of China. My fellow Caps fan, Dr. 8, says paper money was invented in China. Exactly. And China's actually going the opposite way of a gold-backed yuan or a gold standard. They're going the opposite way. They're going crypto yuan. So they're hoarding the gold for the government and the elites, not for the benefit of the Chinese people. And the people are going to get the wrath of a worse social credit score and the wrath of a crypto yuan. More control. When those things are integrated, it's going to be bad news. And that's why a lot of my top sources in mainland China want to GTFO in 12 months or less. Yeah, so paper money was invented in China, and the Chinese are going to be the first to establish a government crypto yuan and then integrate it in a very Orwellian, very Black Mirror way with social credit score. Crypto yuan plus social credit score. Yeah, so anyone who says China's going to a gold standard, the facts, the reality say the exact opposite. But I won't let that get in the way of a good narrative for the gold community, who gets 10 times as many clicks and views and email subscribers as I do. because it's really easy to say Shemitah, January 14th, prediction date collapse, gold back Petro Yuan, gold traded note, gold back crypto Yuan. My friend Louis Camersano has a whole list of all these ridiculous. Louis Camersano Small Gold has kept a list of all these ridiculous calls over the last 10 years. Benjamin says the U.S. might not be in a gold standard, but you can be on a personal gold standard. Exactly. You can be your own central bank. You can hedge. Cesar, I did not look at the non-farm payrolls today. I'm sorry. Oh, we got a super chat from Venetian Lion. Can we trust any of the data the Fed publishes? Some of the data might be okay. But overall, normally they're looking for certain narratives. Like the jobs data is always going to be more positive. The GDP is always going to be more positive and not count the real inflation rate. The inflation data is always going to underreport inflation. Now, there's going to be snippets in that Fed data talking about, like, for example, the Fed's stability report that I talked about that came out in November, how leveraged loans are growing at they are glowing because they are toxic sausage. How the Fed's leveraged loans are growing 14% annually per year, and this is all a result of the central banks and governments' financial repression, manipulating interest rates artificially down, and then savers and retirees are so desperate for income that people are willing to take ridiculous risks for an extra couple 2% per year, 2 or 3% per year for leveraged loans and collateralized loan obligations. So that's why leveraged loans and collateralized loan obligations have exploded in amounts. You now have, I'll talk about this specifically on another show. Leveraged loans are growing 14% per year, insane growth rate. But it's over $1 trillion market now for leveraged loans, and collateralized loan obligations are over $750 billion. So those are ticking time bombs. There's a lot of problems in those. Very similarly to subprime mortgage-backed securities were 2006, 2007 before they all blew up. So there is some good data hidden in some of the Fed's numbers. Remember, in 2019, there was the amount of defaults on subprime auto loans that the Fed was tracking, an insane amount of subprime auto loan defaults. So occasionally there is good data in there. It's normally buried in a bunch of, it's like a needle in a haystack or like a diamond buried in the rough. I was going to use like a gemstone buried in poop, but I don't think that would have been, well. What inflation metric do I use? I look at the Chapwood Inflation Index, which I think measures consumer prices better. So Chapwood Inflation Index, I think that uses John Williams of Shadowstats numbers. I've talked about that for 5 years. But the best way to measure inflation is in tracking the money supply. So money and credit. Because eventually the money supply growth and credit growth leads to asset price inflation and eventually goes into consumer prices. So the Austrian school has a true money supply. You can look that up. That has calculations. Thank you, Justin, for the super chat. Okay, I'm taking a look at listener questions and comments. Then I'm going to close out the show a little early. Adrian says the gold in the photo is fake. Yeah, it's just a cartoon drawing of the gold bars. I think it's a cartoon. It just looks cool, though. Chris is doing her best Ricky Gervais impression. If you haven't listened to it yet, Ricky Gervais's opening monologue, that 7 minutes and something seconds from the Golden Globes, that was unbelievable. That was so funny. He said a lot of the stuff that everyone has been thinking. Unfortunately, calling out Hollywood on their own hypocrisy is a big no-no. So, he will probably get paid work, but he said he doesn't care. Good for him. That took some real balls. A strong dollar, finance freak, it doesn't have to do with Brexit. It's way more complicated than Brexit or anything like that. If you have not watched, go and listen to, listen to my 6 or 7 minute long dollar tug of war video where I explain the two powerful forces pulling against the dollar in different directions. IBJI says gold could go to an all-time high. Silver will still be at 18. I don't know about that. I think silver will eventually start to catch up. What we really need for silver to start going is we need some of this silver byproduct from copper and base metal miners to come offline. That's what we really need. That will really, really help. So we need some of these higher cost, over-indebted copper miners that don't care about their silver, hedge all their silver, basically willing to send all their silver at a discount to the bullion bankers in exchange for loans and hedging contracts and all these other things. We need these base metal miners to either go out of business or stop hedging. Preferably go out of business. Because these base metal miners, a lot of them hate silver. They don't care or they hate silver. The base metal byproduct silver is what has helped keep the price of silver capped. Not only the paper price manipulation, but also the excess supply, in my opinion. Thank you for the super chat, Greg. Wow, we have 4 super chats now. Not bad. Greg asks, in his super chat, will the Fed be forced to lower interest rates to keep us out of recession in 2020? Greg, at this point, I don't know what lowering interest rates would do. There's already way too much credit, way too much debt. So I'm not sure lowering interest rates would really do much. The Fed has said they don't need to lower rates, but they could change at any time. They have said recently a number of comments out from Fed governors that they do not need to lower rates anytime soon. So they're planning for 2020. So it would depend if the yield curve inverts again. If the yield curve inverts again, Greg, I could see the Fed doing a lot of rate cuts quickly. 2, 3, 4 rate cuts to try to uninvert the yield curve. I didn't listen to Marin Katusa on Macro Voices, sorry. I didn't listen to that interview. The problem, Greg, is while the Fed was lowering interest rates before they did quantitative tightening, that all these corporations issued way too much corporate debt, borrowed way too much, and these leveraged loans and CLOs and subprime auto and student loan debt, everyone borrowed credit card debt, everyone borrowed and dollar-denominated debt outside the United States, everyone borrowed way too much. So while the Fed was lowering rates, and these other central banks were doing a bunch of crazy stuff too, everyone borrowed way too much debt while the central banks were doing Japanification and financial repression and cutting interest rates. And then that's why these central banks have to expand their balance sheets, because these debts are going to default. And then that's going to set off these economic landmines. Lowering rates equals a little more debt, but if companies, corporate bonds and junk bonds and leveraged loans are already defaulting, lowering rates won't stop it. So if you go back and look at Greenspan before he left the Fed prior to the 2008 financial crisis, he did start cutting rates, but it was too late prior to the 2008 financial crisis. Marin mentioned dollar tug of war. Oh, he must have listened to my video. Wow, another person not giving me credit. I'm so surprised. Just like Repo Madness, how it has like thousands and thousands of mentions on Twitter. And Bloomberg and CNBC and Macro Voices and Hedgeye and Real Vision TV. King Smith asks, can you explain what real rates and nominal rates are? Nominal rates are the interest rates that you see published. Real rates are what interest rates, if they were positive, if real interest rates were higher than the real inflation rate. So that would be a real interest rate. Unfortunately, for a lot of these countries, the real inflation rate is higher than the nominal interest rate. So real interest rates are actually now negative. So you have, for example, you have Fed economists now who want to target, either former Fed economists or Fed economists, who want to target a 4% inflation rate. They want an official government inflation rate, which is not the real inflation rate, but still, let's just use this government inflation rate of what, hypothetical on a 4%. And that would be the government inflation rate would be way above any interest rates. So that would allow them to devalue the debt, to devalue currencies, which is what all these overly indebted governments want. All these governments want to devalue their currencies. They don't want to devalue their currencies rapidly. They want to do it under control, a controlled devaluation. They want to devalue the debt. The U.S. wants to devalue its debt. This is why Trump doesn't want a strong dollar. He said this. This is why Trump wants negative interest rates. Yeah, I don't have any, Rob, I don't have any dollar bets. So I'm just hedged with gold and silver and gold companies and some silver companies for speculation. But I'm just, as an analyst, looking at the dollar and the forces going on with the dollar. And there's a lot of smart people on both sides of the dollar camp, on the dollar collapse and also big dollar rally. And the dollar tug of war is looking at both of those camps and then looking at the price action in the dollar index and the trade weighted dollar and seeing it's a lot more complicated than either side understands. Yeah, so there is no real positive interest rates right now anywhere. There's no real positive interest rates. Globally already there's now the gold price is reflecting this, I think. I think more people are starting to wake up, more professional investors, people in Europe, because the buying of gold in Europe is starting to really increase. Oh, I'm not a big dollar bull. I'm not predicting a massive dollar rally. I think the Fed, number one, the Fed doesn't want a dollar rally. Number two, the U.S. Treasury doesn't want a dollar rally. Number three, President Trump doesn't want a dollar rally. So if Trump wins the 2020 election, I mean, he's going to tell the Treasury Department, he's going to tell the Fed to make sure the dollar doesn't rally. So whatever policy levers the Treasury pulls with intervention or exchange stabilization fund, or the Fed pulls whatever policy levers, that will be probably able, this is my thesis now, will probably be able to negate a larger dollar rally. And then there you go, that's your tug of war, where the dollar doesn't move much despite a ton of crazy things going on both sides on the tug of war. Yeah, I'm neutral on the dollar. I realize all the crazy things going on, but it's more complicated than dollar collapse and more complicated than big dollar rally. And I think people will eventually see that. Now, maybe for a short period of time there will be one or the other. If the dollar were to have a big rally, I think the President Trump and the Treasury and the Fed would panic and pull more policy levers to knock it back down. So a strong dollar rally would be very, very temporary before there was an unbelievable amount of more intervention. Okay, well, I think that's enough for tonight. I've been speaking more than I wanted to. There is 200 people watching, and I appreciate everyone who is listening to this podcasts with unique information, content, analysis, research, and financial education. And if you want to take a look at some of my more unique content that's added bonuses with other research behind my Patreon account paywall, there is over 200 Patreon account contributors. Hopefully in the next 12 months or less than 12 months, there will be 300. And I just added a couple more monthly PayPal contributors today. So that's really good. And 2020's, regardless of what the dollar does, I think 2020 should be a good year for the gold price. I don't think we'll get to $2,000 an ounce this year. Probably less than 3 years now, considering all the craziness that all these different central banks are doing. I would say probably less than 3 years now we'll have $2,000 an ounce gold, regardless of open interest on futures contracts and other craziness that happens in the gold market. We should have $2,000 an ounce gold now in under 3 years. I think that's a reasonable prediction, not $87,000 an ounce gold. I think $2,000 an ounce gold in under 3 years is reasonable. Try to be somewhat measured and reasonable with my predictions. Okay, well, that's it for tonight, and I will work on I have a lot of other projects I have to work on and a lot of other interview guests that I'm trying to get booked, and it's going to be fun because now I get to do this full time and focus on good content. Bye, everyone, for now.